Hello, welcome back to my channel, and so this is Eric here, and so today we're going to talk about some kind of investing methods that have an attached put option, yeah. And so what it means is that when you invest, sometimes you make money, sometimes you lose money. But if you invest with a put option, that means like for example, if you buy a stock and the stock price goes up, then you make profit, yeah. But if the stock price goes down, you can demand your money back, yeah. You can ask for your original investment back, and then that means you're protected against the downside, yeah. And so that's what I mean. That's what I mean by a put option, yeah. And so it turns out that there are a couple of ways. There are actually more than a couple of ways to invest with this kind of attached put option in the real world, yeah. But basically, investing with a put option is more or less the same as like some kind of a structured product, a structured product that says that it will preserve your capital, yeah. So investing with a put option is more or less like that, that kind of a structured product, yeah. So let me give you a couple of examples, very famous examples where investing comes with a put option, yeah, to protect your downside, yeah. And then so the first one is investing in an unregistered company. Okay, so normally, like if you buy a stock in the stock market, yeah, and that stock is referring to a public company, and the public company must be properly registered with the Securities Exchange Commission in the U.S. or any other authorities in the jurisdiction of the financial markets, and but sometimes a company can be unregistered, through no thought of their own, because sometimes they may have forgotten to do it, or sometimes they might have done it improperly, yeah. So then that public company ends up unregistered. So what happens is if you buy the stock on an unregistered company, what happens is if the stock price goes up, then you don't have to say anything. You can just pocket the profit, you make money, and then you're happy man, yeah. And then eventually, the unregistered company will correct itself. Like for example, eventually it will find out that it is not properly registered. So therefore, it will re-register with the Securities Exchange Commission, yeah, and things like that. So therefore, they will mitigate this registration error sometime in the future, yeah. So therefore, if you buy stock in this company, unregistered public company, I mean, you don't have to say anything, and then eventually the company will mitigate this unregistration problem, and then you can keep your profit, But in the meantime, if the stock price goes down, and this is where the put option can be exercised, and so if the stock price of a unregistered company goes down, you can say to the company, you dirty bastard, you fooled me into investing into your unregistered company. Now I want my money back, I want you to pay back my original capital invested, And by law, they have to do that, they really have to give you your money back, yeah. And because the fact is that the company is not has not been properly registered, yeah. I mean, they might re-register with the Securities Exchange Commission a little bit later, but in the meantime, they have no choice, but by law they have to give you your original investment back, yeah. So this is what I mean by investing with a put option, and but admittedly, this is it's not something that you actually actively go out to seek, It's just one of those fortunate circumstances where you find yourself investing in an unregistered company, then suddenly you have found yourself a put option attached to this investment, yeah. And so therefore you're not actually actively seeking to invest in an unregistered company. That means you're not actively seeking to invest in a stock that has a put option, yeah. But in the second case, this is where you actively seek an investment with a put option, So I'm talking about distressed bonds, yeah. So let's say, for example, for the moment, Credit Suisse is in a lot of trouble, and people are speculating that the Credit Suisse may go bankrupt, yeah. And so therefore, the 10-year bond, the 10-year corporate bond for Credit Suisse is trading at a distressed level. Like for example, it is trading at about 50 cents in the dollar, yeah. So that means you can just pay for 50 cents, and you get a bond that is worth $100 on maturity, plus all the intermediate interest, of course, yeah. And then so what happens is this is a classic example of an investment with a put option. So what happens is, so let's say you invested, say 50 cents in the dollar for this 10-year corporate bond for Credit Suisse, and then so let's say, for example, Credit Suisse comes through with the corporate restructuring, and then they manage to solve all their problems, and then they come out unscathed without any bankruptcy problems. Then of course, their senior 10-year secure bond is going to recover, and it might recover, say, from the original 50 cents in the dollar. It might recover back to, say, 80 or 90 or even 95 cents in the dollar. And so that means, your original investment has almost doubled, because you originally invested only 50 cents, yeah, and now it's trading at 90 or 95 cents in the dollar, yeah. And so this is where you don't need to exercise the put option. But if the worst comes to the worst, if Credit Suisse goes into bankruptcy, yeah, that means that they cannot solve the corporate restructuring problem, and they go into bankruptcy, then this is where you can exercise your put option, So what happens is, because you are you're the holder of a senior secured bond for Credit Suisse, and if Credit Suisse goes into bankruptcy, then you can sue them. You can sue them in court, yeah, and sue them in court, and then say, I hold a senior secure bond, 10-year bond from you, and you have no choice but to pay me back the original principal, which is 100 cents in the dollar, and then so what happens is you will go to court, and then you'll hire a lawyer, and then they will hire a lawyer, and then you will battle it out in the court, and then see if you can get your 100 cents in the dollar back, yeah. And so this is the situation where the put option is actually not completely risk-free, yeah. It's not like in the first example where the put option is absolutely risk-free, yeah. But in this case, the put option is not risk-free because you sue Credit Suisse in court, but Credit Suisse may be in a lot of trouble. They may not even have enough money to pay back even their senior secure bonds, And so therefore, you sue them in court. You exercise this put option to ask for your 100 cents in the dollar back, but they may not have enough money to actually pay back the senior secure 10-year bond for 100 cents in the dollar, So then, you exercise this put option, but this put option is risky, There's no guarantee that you can get your original investment back, But I mean, even if Credit Suisse is not going to pay back the original entire principal of 100 cents in the dollar, I mean, they might, scramble enough money to pay back, say, 80 or 90 cents in the dollar for the senior secure 10-year bond, yeah. But then that would still be a winning case for you because, because you originally invested only 50 cents in the dollar for this secure 10-year corporate bond for Credit Suisse, yeah. And if Credit Suisse decided to, pay you back only 80 or 90 cents, then you still make a huge profit, on your original investment of 50 cents in the dollar, So it's, the put option is not exactly risk-free, but you can still stand to make a lot of gain, yeah. And if you exercise this put option, that means that you will sue Credit Suisse in court in the hope of getting all the 100 cents in the dollar back, yeah. And I mean, there are investments with these kinds of attached put option, yeah. Maybe in the next video I'll find some. In the next video I'll find some more examples where you can actively seek out investment with a attached put option. All right, I'll see you then. Bye.